The U.S. Treasury yield curve might sound like something only economists care about, but it's actually one of the most important tools in the financial world. It influences everything from mortgage rates and student loans to stock market trends and even job security. Understanding the yield curve isn't just for Wall Street, it's for Main Street too. When the curve shifts, it can signal economic growth or recession. And if you know what to look for, it can help you make better decisions with your money. In this video, we break down the top 10 Treasury yield curve facts every American should know, whether you're a seasoned investor or just trying to stay financially informed. 1. What the yield curve actually represents. The Treasury yield curve is a graph that shows the interest rates, or yields, on U.S. government bonds of various maturities. From short-term, like 3-month Treasury bills, to long-term, like 30-year bonds. In simple terms, it tells you how much return investors demand to lend money to the government for different lengths of time. This curve is considered a reflection of investor sentiment, expectations about inflation, and future economic conditions. 2. The normal curve signals growth. A normal yield curve slopes upward, meaning that longer-term bonds have higher yields than short-term ones. This makes sense because investors expect to be compensated more for locking up their money for longer periods. When the yield curve is normal, it usually signals confidence in future economic growth, and businesses and consumers are more likely to borrow and spend, which further stimulates the economy. 3. An inverted curve is a red flag. One of the most important signals the yield curve can give is when it inverts, meaning short-term yields become higher than long-term yields. This often happens when investors expect an economic slowdown or recession. Historically, an inverted yield curve has preceded every U.S. recession over the past 5 decades. While it doesn't guarantee a downturn, it's a strong warning sign that should make anyone take notice. 4. The Fed doesn't control the whole curve. Many people assume the Federal Reserve controls interest rates across the entire yield curve, but in reality, the Fed only sets the federal funds rate, which influences the very short end of the curve. The rest of the curve, especially medium and long-term yields, is driven by market forces, including investor demand, inflation expectations, and economic outlook. This is why the yield curve can tell a different story than the Fed's policy intentions. 5. Yield curves guide loan and mortgage rates. The yield curve directly influences borrowing costs for consumers and businesses. When the curve steepens, long-term interest rates rise, which means higher mortgage and loan rates. When the curve flattens or inverts, borrowing can become cheaper in the short term. Understanding this relationship can help individuals decide when to refinance a mortgage, lock in loan terms, or even choose between fixed and variable rates. 6. It's a barometer for investor sentiment. Investor behavior plays a massive role in shaping the yield curve. When investors are optimistic, they tend to sell short-term treasuries and demand higher yields for longer-term investments, steepening the curve. When they're worried about the economy, they flock to long-term bonds for safety, pushing down those yields and flattening or inverting the curve. In this way, the curve becomes a kind of mood ring for financial markets. 7. Corporate decisions are influenced by the curve. Businesses use the yield curve to make strategic decisions. A steep curve might encourage companies to borrow and invest in expansion, while a flat or inverted curve may signal that it's time to conserve cash and reduce debt. If you're invested in the stock market, yield curve shifts can influence corporate earnings and stock performance. CEOs and CFOs closely monitor it to manage risk and timing. 8. The curve affects retirement planning. If you're saving for retirement through bonds or bond funds, the yield curve can directly impact your portfolio returns. A steep curve can provide better returns on longer-term bond investments, while an inverted curve might prompt a shift toward shorter-term securities or alternative assets. Understanding how the curve impacts fixed income products can help you build a more resilient retirement strategy. 9. Yield curve control has been used in the past. Yield curve control, YCC, is a monetary policy tool where a central bank directly targets specific yields on longer-term government bonds. While the U.S. hasn't used it recently, other countries like Japan have. If ever adopted by the Federal Reserve, YCC could alter how the yield curve functions and change the dynamics of inflation expectations, savings strategies, and investment behaviors. It's a lesser-known but important policy tool to be aware of. 10. Yield curves can flatten without inverting. Not every flattening of the yield curve leads to a recession. Sometimes the curve flattens simply because the economy is maturing or inflation is stabilizing. A flat curve means there's less difference between short and long-term rates, which can signal caution but not necessarily doom. It's important to look at the broader economic context and other indicators, such as unemployment, consumer spending, and corporate earnings, when interpreting curve changes. The U.S. Treasury yield curve may look like a simple line on a graph, but it tells one of the most complex and important financial stories of our time. From forecasting recessions to guiding mortgage rates and shaping retirement planning, its influence is far-reaching. Understanding the yield curve gives you a powerful edge, one that can help you spot economic trends early, time your financial moves wisely, and better protect your hard-earned money. As we face an ever-changing economic landscape, keeping an eye on this silent predictor can be one of the smartest money habits you adopt.